Ladies and gentlemen, welcome back to the 39th Annual Conference as hosted by the Institute of Chartered Accountants of the Caribbean, our second offering from a virtual platform. We hope that you enjoyed your networking break and that you visited the booths provided by our key sponsors, Ernst & Young, CPA Canada, and the Barbados International Business Association. As we continue with our agenda, we turn to IFRS 5 and IFRS 15, two standards that our executive body thought would be pertinent to you, especially as we embrace the theme that we have for this conference, which is, of course, global disruptions, regional resiliency. To lead this session is Professor Adam Deller at the University of Liverpool. I'm reading his bio, which did make me smile, by the way, Professor. I am a lecturer specializing in financial reporting, particularly focusing on the application of international financial reporting standards. I write a monthly article for Accounting and Business magazine for ACCA members to access as part of their continuing professional development. I have spoken at national and global conferences, in addition to presenting videos around the current issues in the financial reporting community. And by the way, it was one of those videos that led us to this occasion. I have a top 3 accounting standards, which means I do not get invited to parties often. But we're absolutely sure that we're going to enjoy your presentation and learn from it. So over to you. Thank you.
Thank you very much, Renata. I was sometimes my biographies they come back to haunt me, I suppose. So we are going to look at two of the kind of slightly newer, I guess, international financial reporting standards. IFRS 5 is not that new, but it's certainly in the accounting world, which can be slow moving, shall we say, in the regulatory world. It's one of the newer ones, and we will finish today by just at least maybe looking a little bit forwards of what else is on the horizon. And the good news for many of you preparers and auditors is that there aren't really any new standards on the horizon that we need to be aware of that there will be anytime soon. So we'll cover the major things, but there isn't going to be another big revenue standard or leases for a number of years, certainly, I would imagine. So in terms of looking at what we're going to do, as you see, Renata's given my introduction already. So I'm a lecturer. I lecture in financial reporting mainly. I do things with the ACCA in various guises, as we've said. And one of the things that I like to do with my students is in the final year of their degree, I teach them about analysing businesses, but from a financial reporting perspective, where they get the profit or loss, they get the statement of financial position, they get the cash flows, and they really dig around a whole set of research databases and then write a report on whether the company's in a good financial position, whether they would be a good investment or not a good investment. But as part of that, I get them to select what they regard as their key accounting standard for this business and why they think it's a key accounting standard. And at the end of their final year before they graduate, they all get to come to my office and they get to sign the wall. I have a whiteboard wall. I'm not just a vandal, and they just sign it with their favourite accounting standard and their name, just as a reminder of who they are. So this is the wall in my office. One of my colleagues is the football finance expert of the UK, and so he's often on BBC News doing football finance things. There's a lot more call for that than financial reporting standards, and he sometimes sits in front of my wall, which must look crazy on national news. It must look like the ramblings of a lunatic, but that is my students, and they don't think they're going to get a favourite standard, but by the end of their 3 years, we've just done enough to coax one out of them so that it can at least sign the wall. Now, you might see on there is no IFRS 5. It's not there. It's not a particularly common choice. There is a couple of IFRS 15s, which is controversial to me, but we'll see. a lot of them pick IFRS 16 leases, despite the fact that I tell them that that's an obvious choice, and that's like, you know, that's like dating a model. It's like going for the obvious beauty. You can't really do that, but they are who they are. And so, yeah, mine is IAS 38, just because it is very broken, and I get to talk in class and write a lot of articles about why the standard is out of date. So it's given me a lot of work, IAS 38. So that is my favourite. But we're not asked about my favourite today. We're asked about IFRS 5 and IFRS 15. So IFRS 5 is in many ways quite a simple standard. It's not one that has the complexity of a financial instruments or the calculations of a leases, or even a lot of the judgments of revenue, which we'll see later. But it can be one of the most useful standards. And we're going to see that actually there is a little inconsistency maybe with how firms globally have been applying it. And maybe this is a plea for you preparers or you auditors for maybe in your companies to see if we can implement this as I believe it should be implemented. And there's two things that we will look at here. We're going to look at discontinued operations, and then we'll touch on non-current assets held for sale. So it really is looking at a major part of the business that's gone. And so that's what we're going to be looking at. It's a major part, a major line of business, or a geographical area that you've either sold already, or you've closed it down, or it classifies as held for sale. Now, as a reminder, held for sale is not just, oh, we might sell it in the future. There are strict criteria which we will revisit of how to classify part of the business as held for sale. So it relates to a major line of business. And as we'll see, that already causes us a little bit of judgment there. As soon as we see major line of business, we bring judgment in there, because as with a lot of international financial reporting standards, there is no guidance of what a major line of business is. And I know this morning there was a session on the situation in Ukraine and Russia, and a lot of businesses will have, you will have seen in the news maybe yesterday that Nike have closed down their operations in Russia. And a lot of global businesses will have done that over the last few months. And the question that they will have to answer is that a major line of business? And therefore, could that be a discontinued operation? So someone like Nike, who maybe do 1% of their business, they estimated in Russia, it's probably not a major line of business, and therefore they probably won't have the disclosures that we're going to look at here. Whereas somebody like McDonald's, who estimate that 9 or 10% of their revenue comes from Ukraine and Russia, well, once they closed everything down and sold off their Russian part of the business, this may well become a discontinued operation. So it can be a pulling out of a certain nation, or closing down a division, or, as we'll see, selling a subsidiary. So major line of business, and the whole point of the standard is to say to your shareholders and the users, look, there's a section of this business that will not be there next year, or that will be at least sold next year, so will not have a full year next year. And that's trying to give valuable information for the users so that they can really see which part of the business will remain and which part of the business is that will be removed. And we're going to see that there's a whole set of disclosures behind that. The most important part of the disclosure for a discontinued operation is how it's presented in the statement of profit or loss. And that is that if the division or the subsidiary or the geographical region is classed as a discontinued operation, all of the results of that part of the business need to be shown separately. So they're not in revenue, they're not in cost of sales or admin or distribution. Everything to do with the part of the business that will be gone is in one line. And that one line should be at the bottom of the statement of profit or loss as profit or loss from discontinued operations. So the presentation will look a little like this. You will have the continuing operations at the top. So this is simply the remaining business. So from the top down to profit from continuing operations, that tells the users this is the part of the business that will still be there next year. And in my days as an auditor, when I was with PwC, one of my first ever clients, I came across this when I had a client that did bookmaking and casinos. And in the year that I was on the client, they sold the bookmaking business. And so instead of going from a business with two strands, bookmaking and casinos, they were solely going to be a casino business going forward. And so in their statement of profit or loss, what it needed to show was just revenue and profit from the casino business. And then the shareholders could know that is the business that will be there next year. And at the bottom, you've got this one line, profit from discontinued operations. And that's where all the results of the bookmaking business, all of the revenue, the expenses, any impairments, any gain or loss on disposal, that's all in that one line. Now, obviously, one line isn't that useful in itself because that can sweep up everything, the revenue, the profits, the gain or loss on disposal. And hopefully, good, well-prepared sets of financial statements will have a good disclosure of how those results are broken down. And that's what we're going to see when we look at a couple of specific companies here. Non-current assets held for sale, that's just the fact that your discontinued operation may not actually have been sold during the year. Now, you can have non-current assets held for sale that are not a major line of business. So you could have these without showing a discontinued operation. So these could be just anything such as property or non-current assets that you're now getting rid of. And you can show them as a separate line in current assets, just to say again to the shareholders, these assets will not be here next year. Obviously, if this is a subsidiary or a division, what you would do is you would bundle together all of the assets and show those as assets held for sale. And you would actually show all the liabilities of the subsidiary and bundle those together in one line, saying here's the liabilities of the business that we're selling. Now, the key rule when you're doing this is to exercise a bit of prudence, and that's that you show this asset at the lower of the carrying amount and fair value less cost to sell. Now, that is really just an echo of the impairment rules of non-current assets. The difference is there is no value in use because you're not planning to use these anymore. So you take these out of non-current assets, you put them in current assets, and the impact of this will be that you record any loss straight away. So if these are going to be sold at a loss, that loss is recognized immediately, but any gain will only get recognized on actual disposal. You're not going to recognize any gain before you sell that. Obviously, we've all seen clients and we've all seen businesses that are not prudent in their judgments and will try to say that that can be sold at a large gain, which may or may not work out to be the case. So if you're looking at this discontinued operation, it's got to be something that's going to have a major effect. And that's the thing to kind of bear in mind. That's the judgment that we're going to have as we look at some real life examples here, and try and think about your clients and who they have and your businesses. What are the major parts? And if any of those were to be sold or to cease, would they be a discontinued operation? Would they need to be shown separately? IFRS 5 and US GAAP are kind of converged. They're very, very similar. They have very similar rules. US has no reversal of impairment, whereas IFRS, you can reverse your impairment if you can see that there's a reason that that's changed. But basically, they're the same basic principle. So that's going to take us into our specific examples. So in the last year, Adidas has sold Reebok. So for years, Adidas acquired Reebok for about 3 billion euros and poorly performing, really unpopular part of the business, real problem element of the business. And finally, they decided that they were going to sell it. They'd had it for long enough. They actually, as we'll see, sold it at much less than they acquired it for. But that is clearly a large part of the business. You've got this whole brand that you used to own, and now you're going to have sold it. Now, this is a terrible slide, but I just wanted to show that this is their whole statement of profit or loss. Don't worry, I'm not going to walk you through all 100 numbers that are in there, but just going to zoom in on the bottom part, which is the discontinued operation part. And so you can see there at the top, you have the income from continuing operations. So that's saying that Adidas has made a 1.5 billion profit from the Adidas and the remaining parts of the business. And there's a big gain from the Reebok. So you've got 666 million gain from Reebok's division there. And so that tells me, right, next year my recurring business is 1.5, but actually I'm selling a business that seems like it's a very profitable bit of business. But that's where we need more disclosures. Now, that 666 miraculously somehow turns into 654 when you follow their notes through. I'm sure they'll blame it on currency exchanges and so on. But if you were to work through this shows the results of Reebok's business. But there's a big line in there, the third line down, which basically says there's a gain or loss from a reversal of impairment of the Reebok trademark. And so they basically had previously impaired the Reebok brand effectively. And now that they were going to sell it, they were saying, actually, we could sell it for quite a lot more than we thought. And so they'd reverse the impairment on that brand, not on goodwill, but on that brand. And so it's not necessarily a day-to-day trading loss. It's a judgmental reversal of impairment. So if I'm looking at this as an investor and say, oh, there's a gain of 600 million, I'm also knowing, well, 550 of that is just a reversal of an impairment. So it's a very small, profitable business in terms of buying goods, selling goods. Without that impairment, it's really not much more than break even. You can also see in the statement of financial position, again, we're just going to dive into specific parts there. This was the Reebok assets, because they're selling a whole division, and you bundle all of those together into current assets, and you can say 2 billion, that's all the assets together in one. Similarly, you've got all the liabilities together as well. So you can say, here's the part of the business, here's all the assets that will disappear, but here's the liabilities that will disappear. So you could kind of net those off and say that's about 1.5 billion in the balance sheet. Turns out they actually sold it for 2.1 billion euros, okay, which was actually much less than the 3 billion euros they paid for it, but they're able to record a gain on disposal because the assets are only in the balance sheet at 1.5. They sell them for 2, they make quite a nice little gain on disposal, even though it was much less than they acquired it for years earlier. But because of the accounting, because of things like depreciation and amortization, they were able to book a gain. And then again, some very good disclosures from Adidas. They just really broke down what all of those assets are. We're not going to go into them, but again, that's excellent disclosures where you can just really say, here are all the assets in that business and all the liabilities that existed in that business that we are getting rid of. On a similar note, Tesco, the large supermarket in England, they sold their Malaysia and Thailand businesses. So rather than selling a specific company that they owned, they were pulling out of a geographical area. And obviously, as we said, this may be something we see in some of the more global businesses in the next year or so. And so again, similarly, you've got the income statement there, and at the bottom, you've got this discontinued operation. And so if you just look towards the bottom, you can see there's a 1.7 million profit for the year and a very, very small loss from discontinued operations. And that's because in the 2022 annual report, it was just a small part that was disposed. But in 2021, there's actually 309 million that was disposed. So you could see, if you look on the right hand side in the white there, it's a much bigger set of figures with a huge gain, as we'll see there, on disposal. And that's really the Malaysia and the Thailand operations. Again, not going through all of this, but just a highlight in that table, right towards the bottom of that table on the first column of the white figures, there's a huge gain on disposal of Thailand and Malaysia, a massive $5 billion disposal. And that's really useful because Tesco actually used this to pay a significant one-off dividend to the shareholders. So a well-informed investor who's reading the accounts will look at that and understand where the dividend has come from, that it's not just the expected dividend, but actually it's because we've pulled out of a major part of the business, and that major part of the business may have generated 300 million a year, but we sold it at a huge gain. Now, even though they're both good examples of disclosures, there are differences in the way that both companies have chosen to do this. Adidas have more information such as employee numbers, reallocations of goodwill. Tesco don't have those kind of things, but they show it as a segment. What is interesting is in segmental reporting, where you have to pull out the major parts of your business if you're listed and show the results from them, Adidas actually don't regard Reebok as a segment. They never said that that was a separate segment, which is just a part of the business that earns revenue and incurs expenses. Adidas simply said, we have one product segment, which is the sale of sportswear and equipment under different brands. And their segments were just geographic, which I would say is a little inconsistent, because if it's not major enough to be its own segment, you could question whether it really is major enough to be a discontinued operation. I suspect it should have been a segment, but they didn't want to produce the results of Reebok separately in segmental reporting in previous years, because Reebok wasn't doing very well. So consider the consistency. Is it a segment? If it's a segment, it's surely going to be a discontinued operation. And if the sale of it would be a discontinued operation, consider whether it should be reported as a separate segment, because I would suggest that it potentially should. Now that takes us to IFRS 15. This is the one that more of you will be interested in. I can understand this. This is the larger one. For many of you that are preparers and auditors, you will have encountered this headache, I'm sure, for the last few years, where your clients had moved from IAS 18 and IAS 11 down to IFRS 15. And I would say it's one of, I don't know if I'm allowed to say that, but it's one of the worst implementations of a new standard. I just don't know if it's really solved the issues that the IASB were aiming to sell. Maybe I'm a little biased because IAS 11 used to be my favorite standard, but IFRS 15 is very, very complex with the 5 steps and how to apply it. And it is very tricky. And your companies will probably still be wrestling with, when can we recognize revenue? You know, gone are the old rules of risks and rewards. When do risks and rewards transfer? You know, that isn't really how we do it. But actually, a lot of firms, because they've kind of looked at the steps that we will walk through, they've gone, I don't think we need to change much. And actually, you'll probably see a lot of companies are still sort of defaulting to, well, it feels like that's when a genuine sale is made. And they're using a bit of a common sense approach, but that might not necessarily be consistent with IFRS 15. Now, IFRS 15 has 5 steps. That's the big change here. These 5 steps, we're going to walk through them using some company examples and actually how it's impacted some of the bigger businesses globally following this move from just risks and rewards transferring into this new 5-step approach. So the first step is to identify the contract. Now, identifying a contract shouldn't really have been an area that changed a lot for people. It shouldn't have been a huge change, because it's just, do you have a contract with the customer? And for this element, most of your clients won't have changed. But for maybe telecommunications companies, this presents real difficulties with things like contract modifications. So if you're a cable TV provider or a phone provider and one of your customers changes their package, well, how is that contract modification applied? Is it something that is then applied over the period, or do you do a retrospective catch-up? Does it represent a new contract, or does it represent simply a change in terms of the existing contract that you had? And these are the complex discussions that actually companies like Vodafone and some of the cable companies here in the UK have really had to wrestle with, is what happens when the contract changes? And unfortunately, there isn't necessarily an easy answer. It's really going to often be to the preparer and the auditor to really argue about, is this a new contract? Is it a modified contract? And is it a new performance obligation? And as we're going to see, the key to this standard is all about performance obligations. That's the terminology that we're using. Is it a new obligation that you have to do as a provider? Just as an example, you can see there Mercedes badge, Daimler, they had to change their accounting for licenses. So it's a bit of a presentational aspect. They used to say, well, if we license things to customers, we can have that license agreement in other income. But actually, once IFRS 15 came out, they said, well, actually, that licensing arrangement is a performance obligation. That is a contract. You can't put that in other income. That is a way that you make sales. So their other income had to jump up into their revenue. Okay, Tesla, they have a similar situation. Theirs changed as well, but theirs is to do with the resale value guarantee. They provided a guarantee that if somebody didn't want their car after 5 years, they could sell it back to Tesla. And so it used to be that that would be a provision as an expense of having to buy that back from the customers. You would record an expense and a potential liability. But now that is regarded as part of the original sale contract, and Tesla have to make an estimate of how many of those will be returned, and they get deducted from revenue. So they're not necessarily changing the profit overall, but they are very much changing that top line revenue to do things like the refunds and repurchasing of things. And that is going to be quite a big difference we see in a few of these companies, is to do with the refunds, the rebates, the compensation. That actually has a bigger impact on revenue than maybe people have thought about. There's also principal and agent things. We're not going to get into that here, but there's a lot of guidance on that in the new IFRS 15 about what kind of contract do you have? Are you a principal? Are you an agent? And how does that affect how you should record the revenue? Identifying the separate performance obligations. So once you've established you've got a contract, once you've established that this is an obligation for you to meet, it's now potentially a case of unbundling all of the different elements of that agreement. Are there different actual performance obligations? Are there different pieces of work that you have to do within that contract? And this has had a reasonably large impact for a few companies. So you can see there, I've got the Microsoft image up there, a huge change for them on the recognition of Windows 10. Previously, they would say, we would sell you an operating system with a computer, and they would recognize that as we're providing a service as an operating system, and they would actually spread that revenue over the life of the laptop to say, well, we're giving you a service for an operating system over an estimated 4 or 5 years. But actually under IFRS 15, it's not a service, it's a good. When you've bought a laptop, you have got an operating system. They have sold you an operating system as part of that good, and they recognize the sale on that operating system now rather than across the period. So there has been a change about some elements that previously companies think of as services, but actually it's a product, and that product, if it's sold up front, you can take the revenue from it up front. McDonald's, they've got franchise fees, so that is now going to be where they actually have to recognize that over the franchise rather than as a one-off revenue hit up front. So again, your businesses, if they've got franchises, how will that change things? How should that change things? And look at some of the illustrative examples in the standard to really kind of unpack the terms of your franchise, and should it be all up front or should it be over the life of the franchise? Tesco, their mobile division has changed, and this is the same with a lot of phone providers. So again, if you're in the telecommunications industry, the vast majority of those now are handsets being recognized up front, and then the actual data services over the life. So that's kind of more brought some revenue forwards rather than spreading everything over the life of a mobile phone contract. The third thing is to determine the transaction price. So once you've identified all the actual performance obligations within your contract, you then have to decide, right, well, what is the price of that contract? Now that seems reasonably straightforward, but this is where you have to account for things like refunds. This is where you have to account for things like variable consideration, where maybe different amounts are payable depending on performance. And so if we stick with Adidas actually for now, so Adidas had to deal with their refund liability. And so actually they used to record this as a net amount. So they would used to record this in the kind of as an expense but now they record the full amount of refunds of goods to customers and liabilities, and they bring in an asset of those goods to come back. So it used to be, let's say Adidas were expecting that they would have to refund $1 million of goods, but they could resell those goods for, those goods at a cost of 600,000. They would just provide for the 400,000 loss. But now you have to provide for the full $1 million refund, and you have to bring an asset in for the expected goods to be returned. So the balance sheet presentation on a lot of these companies for refunds is changing, where you have the full provision for a refund, but also the goods that are likely to come back to you, you have to record those at cost as well. EasyJet compensation for flight cancellations, which is a big deal in the UK. Just at this moment, we're all excited to get away for the summer into places with nice weather, but a lot of our flights are getting cancelled because of staffing issues. Well, those compensations are not recorded as an expense, they're now recorded off revenue. And again, that will have an impact on revenue, even if profit hasn't changed overall. Starbucks, this is just an example of loyalty cards. So loyalty cards, we all know that if you sell a loyalty card for, say, 2 years, some of those are never going to get taken up. And it's called store card breakage, where you will basically get the money because cards will expire. Well, now, instead of that being in other income, we can make an estimate and actually include that within revenue. TUI, which is the package holiday company in Europe. So again, if those of you who are working in the tourism industry, they had to change their policy from, instead of recognizing all of the revenue on a holiday when somebody got on the plane, they would recognize it over the period of the holiday. Now, that's only a 2-week change, but it is a reasonable change. And again, compensation for cancelled elements now has to come off revenue. So that's another big change that could be in there as well. So that actually resulted in $1 billion decrease in their revenue. So a much more significant impact than maybe you would think. So again, if you're in a travel or a tourism industry, think, has my actual revenue changed since IAS 18? Even though this has been in play for a few years, you might need to look at the examples of tourist industries, look at other companies and think, does my policy actually stack up with what the rules now are? As well as then determining the price, you then have to allocate the price to different obligations in there. Rolls-Royce is the biggest impact of this globally. And so Rolls-Royce had this thing called aftermarket rights, which was very strange. They basically capitalized their initial loss and spread that as income over the period because they made most of their money on the after sales service. I would question whether that was in line with IAS 18, but now it's a case of you sell a jet engine, you record that as a sale. And if you service that in 5 years, you don't spread the revenue you're going to get over that 5 years, because that person could just get rid of the jet. They could scrap the jet. When you do the service in 5 years' time, you recognize all of that income in year 5. None of this, well, I'm going to sell it, legally it needs an overhaul in 5 years, that doesn't matter anymore. You will have a separate performance obligation in 5 years, and you would recognize the revenue at that point in time. Disney, we all like to see a little bit of Disney there. So my wife is from Florida, so she's at least part Disney, and so every time we visit the in-laws, I try to get her to Disney because it's better than just spending 3 weeks with your in-laws, isn't it? And so we try and go there, and obviously I would explain to her how Disney's revenue recognition policy has changed, but she is not an accountant and therefore does not give me the eyes that say that she's very excited by my revenue recognition policy while we're walking around Disney. But they had some licensing agreements, and again, that's now in revenue rather than in operating expenses. So any licensing agreements, a lot of tourist companies, a lot of branding companies will have those. All of those now need to be in revenue, not as other income, not netted off expenses. They need to go into there. We've talked about Vodafone, and that will be the same with all phone companies and data plans. It's a real big exercise. Vodafone, in their annual report, they just made a big statement about how arduous this had been. So their revenue went down 1.4 billion, their cost of sales went down 1.4 billion, because they basically had to reduce recognizing some of it up front, but then they could spread some of the costs. And so the impact of profit wasn't huge, but it was such a big exercise they had to do over contracts and modifications, how much of the price is to do with the original handset, how much of the price is to do with the data package and the calls. And really, that is a complex thing. So again, if you're in telecommunications, consider how much you've really wrestled with that with IFRS 15. Airbus, so we've got Airbus. There's a very similar situation to Rolls-Royce, which is that actually they've had to record things when they're doing the service rather than recording this kind of, anticipated over 10 years. It's just a case of when have you done the piece of work? Now, obviously, if you're building an aircraft, that's probably similar to IAS 18. You are providing a service for somebody, you recognize that over the period, and that won't have changed. And then the final step is you recognize the revenue as you do the work. So if you're building an asset for somebody, it probably won't have changed. You recognize that over the time that you're building that asset. Not really a huge thing. Ryanair, when they recognize their revenue in two ways. They recognize it in flying customers all over Europe, but they also have an element of ancillary revenue. If you've ever flown Ryanair, you will know that the flight is very cheap, but then basically everything else costs you money. If you want to bring a bag, if you want to book in and not be at the back of the queue, if you want to actually choose your seat, all of these things have extra costs, which you don't have to pay for, but you can choose to pay for. If you like the person you're going on holiday with, you're probably quite likely to pay for them so you could actually sit with them. And so they're called ancillary revenue. And Ryanair used to book that as soon as somebody had paid for the extra baggage or the seat or anything like that, they would book that as revenue immediately. Again, I would question whether that was ever allowed on IAS 18, but that can only now be taken when the flight goes. Okay, that is recognized obviously when you provided the service. And even though it's a different service than the flight itself, it goes over the same time period. Of course it does. And so that has been recognized in there as well. American Airlines, that they had a huge change to do with air miles. So if that's the case with your clients, that you have loyalty packages, you need to make sure that the points that people are earning as loyalty, they need to be recorded as deferred income and then taken to revenue in the future as they are earned. Okay, much bigger amounts that are getting deferred into there as well. In terms of issues that have been raised within IFRS 15, there's a couple of things that were brought in as well. So discounts, making sure that they are applied to all elements of a package. Financing components, so if people have got a long time to pay, making sure we include those at present value. Sale and leasebacks, one of the key things within leases is to really look at, is it really a sale or is it just simply a lease transaction? Is it simply a financing arrangement? And then sales with goods and services, splitting those out as well. Now, the IASB will be undertaking their post-implementation review, and they're going to be asking questions like, how significant have these changes been? Or how much of an impact have things like variable consideration had? How big is the refund problem? How significant is principal versus agent issues? And they're going to ask for feedback as they do that standard. So if you've encountered problems, then actually the IASB are a good body to just kind of feed back to as part of that review so that they can kind of see what has worked and what hasn't worked. Because it is a complex standard, it is difficult, and it's meant to have brought consistency to things. Now, they've got a lot more guidance and examples in the standard than they used to have, but it is very difficult, and there are still differences in the way people have interpreted things. And so that's the kind of overview of these standards, just as a quick thing of what's coming up in the future. No big accounting standards coming up from the IASB. They've announced a kind of a big agenda consultation where they took feedback on what new standards do we need, and intangible assets is on there. So intangible assets is one that they are going to look at. They're only just starting that, so that you can't expect movement there for a good 3-4 years. But that is maybe the next new standard There is a new primary financial statements project, which will change the layout and the presentation of the P&L with a new investing activities kind of section, and they're considering changing the cash flows. Goodwill and impairment is still being discussed, but it's been discussed for a while and they can't seem to agree what they're doing. So I don't expect that to change. But these standards are probably not going to change anytime soon. IFRS 15 might have some tweaks after the post-implementation review, but that is the overview of the standards and the overview of what is to come. So I believe I will pass back to Renata and I will stop talking now. Thanks, Renata.
And thank you very much. I have to say that's perhaps one of the more engaging presentations that I've taken in concerning these standards. Thank you especially for the examples that you provided to us, which I think brought it home in terms of the application of those standards. We have just a few questions. What are the exceptions of IFRS 15?
If you prepare your accounts under IFRS, you wouldn't really be looking for any exceptions really. It will just be a case of doing your best with what the performance obligations are, but don't just default to, well, this is how we recorded it under IAS 18. It's really just a case of try and find out what does the standard say about recognizing revenue over time. That's the big change, and really getting into, is it something that produces an asset for the customer? And if not, it might not be a service that you recognize over time. It might now be that you recognize it at a point in time. And that's maybe the biggest difference that people haven't looked at. So yeah, I wouldn't look at it in terms of exceptions, because really it's meant to be the way that you record your revenue. But it's really just kind of exercising your judgment on what contracts am I doing? Is it, am I providing a good to somebody, which is recognized now, or is it a service over a period of time? But making sure you looked at those definitions within IFRS 15, because they're not the same as they used to be under IAS 18.
Thank you. And other question, please confirm, does IFRS 15 supersede the current revenue recognition standards?
Yep, IFRS 15 has been implemented since 2018, so hopefully, yeah. So IAS 18 and IAS 11 are absolutely done. If you report under US GAAP, it's ASC 606, but that's very much the same as IFRS 15. So they are the same sort of standard, really. They're very, very similar rules, almost identical. They were developed sort of together. So yeah, this is the standard that should now be being followed, rather than IAS 18 and IAS 11. They are by the wayside now.
Thank you for that confirmation. And I think this next question is in reference to your Ryanair example. When the miles expires, does the airline reverse the deferred income?
Yes, so again, they can make an estimate of that, a bit like we said with the Starbucks example, where you've got a loyalty card and you know there's going to be this breakage, you know there's going to be 10% that don't get claimed. So you might be able to record 10% or whatever the history tells you immediately in revenue to say, we know this will be kept as revenue. But if those miles expire, absolutely reverse the deferred income and they can go into revenue at that period, because at that point, you know you've got those miles.
Gotcha. And what looks like final question, and I think you may have covered this. What is a disposal group? And this is in reference to IFRS 5.
Yeah, so a disposal group will just be a group of assets that are held for sale, largely to do with a division of your company or a subsidiary. So rather than just selling one piece of property, you are selling, say, Reebok, or you're selling all of your stores in Russia or something like that. So you're really selling a whole section of assets. That could even be a company that owns other companies, but it's really selling a whole group of assets rather than just an individual item of property, plant or equipment.
And someone who unfortunately said he got knocked off because he's on the road. Clearly our accountants are multitasking. Not too sure how safe it is to be taking in the conference from, the road while driving. But the question was, did Professor Della speak to reward programs and gift cards?
Yeah, so reward programs and gift cards, we said with the Starbucks example, so you could record some of that immediately, but then most of that will be in deferred income. And it's actually reasonably consistent with how the IFRICs were that came up with IFRIC 1213 that used to be in place for that. It's very similar, where you have to allocate some of the points that are made initially. So you take that off your initial revenue and actually hold that as deferred income. So if someone spends $100 of your shop in your shop, but actually some of that is reward points, you wouldn't recognize all $100 in revenue. You might recognize 97, 98 and deferred income with the other 3, because that will be taken to revenue when they cash in those points. So that's actually quite similar, apart from the breakage element where you can record that in revenue immediately.
Excellent. Professor Della, thank you very much for your time and the insights spent. I think if any one of us were hosting a party, sir, we will invite you.
Thank you very much.
Absolutely made those standards interesting and very applicable for us. So we thank you for your time, and of course wish you and your family a wonderful weekend. We will be in touch.
Thank you very much.
Thank you.
Martha. Goodbye.
Bye.